At Herd Capital and both strategies, we run a pretty concentrated portfolio. Everything we do is fundamental. I'm looking for debates as opposed to screening into stocks. We typically are looking for 3 to 5 new ideas a year, and we own names for 5 years or greater. So I think like at the end of the day, we're known as domain experts. We're only in 6 sectors, and that lends us to, I think, be able to identify and size things and get the market to see our point of view over time. The 6 sectors are telecom, media, technology, financials, industrials, and energy. My belief is that the best investors are domain experts. Why I took on those 6 is because when you think about aggregate demand for both developed and emerging economies, like those 6 like matter the most in the sense of like giving a, be it an emerging or an established economy, sort of like the opportunity to blossom. I always gravitated toward the periphery of those as opposed to like owning like names that were popular in those 6 sectors, just because I felt like ideas were more likely to be debated, and you're more likely to have like a better chance of producing, alpha or idiosyncratic returns as opposed to like just being in the well-covered, popular, good names, but just different way of approaching things. So it's stuck with me. For us, valuation's always been like about a continuum as opposed to a point in time. We typically look forward, and I think like, if you look at our shorts, like you'll see the way we constructed them. It's basically like we've sold cost to buy puts through what we believe will be a fundamental event. If those puts get monetized, it'll ultimately become like a single name short. But it's without sort of the friction cost of sort of, one stock being borrowed and going long, and one stock being borrowed and going short, and one being long. There's no friction cost there. So I think like from a construction standpoint, that's how we intend to express views as we get through sort of third and fourth quarter of this year. Even as we built like our business and sort of gone after like, different LPs, like it's all been about like, do they believe in meritocracy? Will they speak up and challenge everything? Can I learn from them? Are they going to make us better? And I think like in building a business, like, like those were the people I gravitated towards. Like I knew I couldn't stay at home and twiddle my thumbs. Like my dad was like, you're going to get a job and you're going to work and you're going to get out of here. So for me, it was very much, and I think the industry still is the same. Like it's the industry of like self-selection. Like you put yourself in and you understand that there's risk, but you prepare as if you could be wrong. And I think I was fortunate to find people that challenged everything and expected me to speak up, write things down. And even when I fell, expected me to get up. I typically seek feedback that's opposite of what I believe to be true. So I do the best I can to eliminate confirmation bias, both in life investing. You want to, write down things, assign like probabilities to it. And I think like even in starting my business, like I told myself, like I'm taking a dual path. I'm going to pursue my MBA. Once I raise $10 million, I'm going to stop. And I basically created a decision tree, as I was like building it. I feel like if you're really serious about anything, you have to write it down and keep it objective and keep as much emotion out of it. I would say like people oftentimes focus on like what can go right, like really study like the failures.
I started my career in the early 1990s at Solomon Brothers on the mortgage trading desk. Spent some time at Credit Suisse. I was at UBS for a number of years. And then prior to launching Hollis Park, I spent 7 years at Deutsche Bank running various portions of their mortgage trading team, culminating with running RMBS trading globally. So that, that lends itself to kind of what Hollis Park is and the fact that we are a structured product focused alternative asset manager with, a few vehicles. But I think the key thing to take away from that is, I've been 27 years in the mortgage market. We have sort of 3 distinct buckets that we invest in across the structured product universe. The first being structured rates. We also have a structured credit book, which is anything without a Freddie, Fannie, or Ginnie wrapper we consider structured credit. And so that talks about RMBS, CMBS, CLOs, down to sort of the bottom of the capital structure as far as equity, And then we also have a structured derivatives bucket, which is agency, inversile, IO, and PL. And that's sort of the porridge in between the alpha and the beta. When you think about alpha, you think about volatility going up. When you think about beta, you think about low volatility, right? Intrinsically, historically, beta products have performed well when volatility is tremendously low and have underperformed when volatility starts to really creep up. So when you get 6, 7 standard deviation moves, such that we had in March, they're going to be very, very difficult periods for credit, but intrinsically, it should be very, very good periods for the alpha portion or the rates portion of our portfolio. And we think if you overlay that with the concept of what is liquid and what isn't liquid in today's day and age, you can kind of create the durability that I'm talking about. There's not a huge footprint in the hedge fund space, and quite honestly, the dealer community has lowered their exposure in a $7 trillion market, right? So the opportunity set just from the players that were in it, let's say 4 or 5 years ago, to the players that are in it now is intrinsically higher because there's just less people willing to commit capital, risk, balance sheet, however you want to look at it. So what does that mean for Hollis Park? Well, what do we consider our specialty is in the agency or the rates book, we try to buy collateral or pools of mortgages that are going to prepay slower than the model's expectations. And we try to hedge them with cheapest to deliver or TBA forward contracts on collateral that we think are going to prepay faster than the model. I look at that sector as one that's ripe with opportunity. I think you need to be diligent and thoughtful, and it isn't one size fits all in any way, shape, or form. And the concept of just closing your eyes and buying anything like you could do in 2008, 2009, I think are dramatically different. And this will be a bond pickers market as opposed to a sector market. But I think the opportunity set broadly is really, really good.
Malvika Bhagwat from Owl Ventures joined us today for our speaker series. She currently is the Director of Outcomes and Efficacy at Owl Ventures, one of our partners in the EdTech space. She approaches education from a number of different lenses, having had experience sort of on the philanthropic LP side, working as a member of a startup and now as an investor.
I did an undergrad degree in psychology and quickly realized that I didn't have the patience to be a psychologist, even though I thought that's what I wanted to do. And so kind of stumbled into education as my first job, but quickly was sort of looking at assessment data across India, Singapore, and the Gulf countries to understand how students were learning and what the common misconceptions in student learning were, specifically focused on literacy. So I was at any given point looking at differences in grade level, gender, state. The gaps were huge, and they were enough to draw me to the field. And I think that was the first moment when I started interviewing kids in classrooms and hearing their experiences of what they thought education meant. And the answers were consistently around lack of distrust or like not learning enough, that it was this moment of, this is where I want to spend my life. And that's what then brought me to the US to do a master's in education. Where I focused on technology because India didn't really have a lot of focus on technology at the time. And from there kind of ended up at Newsela, which let me combine my two passions, which was teaching language and literacy alongside using technology as a platform. So that's sort of been my journey into education. And I come from a family of landscape architects and educators as well. So since I disappointed them on the landscape architecture side, at least they're okay that I'm in the education field. On the workforce and higher ed side, I think it's been interesting. I mean, I think in general, overall, the blanket statement to make here is that EdTech is thriving and it's doing well in this scenario, just given that the only option that all these players have is to go online and is to go into distance learning. So that is not the challenge, but within post-secondary, some of the data that's shown has showed that like students are trying to move away and like try to take a gap year this year because they don't know what school's going to look like. There's a lot of negotiation and debate around tuitions. Universities think that they're going to have to pay a premium, but students just don't think it's going to be the same college experience. And so they don't know what their outcomes and what their job prospects are going to look like. And I think now the conversations amongst the students going to college has become very focused on, will this university actually have a plan for me if this virus comes back? Like, am I going to continue being able to continue learning even if the virus comes back or if this pandemic hits again? Are they going to be able to place me? Our goal is that we want to become the thought leader and the sort of voice of good edtech efficacy and outcomes, because we believe that the companies with the outcomes will eventually win in this space, both in terms of sort of outcomes, but also financial returns, just given that when the noise around edtech starts clearing out and people's budgets get thinner, they're going to have to pick the ones that prove outcomes. It's going to be very hard to just rely on marketing headlines.